All right, so stocks followed up yesterday's selling with a really significant bout of selling today, and really kind of showed some breakout signals in terms of trending to the downside, and so I'm going to break that down in terms of like how much and how long and what does that mean in terms of like how bearish can we be without sounding like I'm a perma bear or doom and gloom or apocalyptic, and it's hardly the case. I mean, again, when you inhale, you exhale, and every time you exhale, you're not dying, even though you're exhaling. Same thing. The markets go up, they go down. The markets, you're not dying because the markets are dropping. But if you're going to take a big inhale, you typically got to take a relatively decent sized exhale, and I'm going to kind of break that down and show you kind of where that's going to be and what that's going to look like and how many bullish, how much bullishness we'll see in the midst of that. We've already kind of been talking about that, but I'm going to kind of reiterate and show you some of those charts again, and then why Friday, why these charts now look like we're getting a new leg to the downside, and that leg could last a little bit of time here. We're also going to break down what we might see as early as intraday Monday morning. How could the market respond to some pretty significant selling the past 2 days? So we'll talk about that. We'll talk about what's driving this price action. Very interesting move in the dollar and some sector moves. Everything's dropping. What does that tell us? And then our trade idea of the day is very typical bearish trade that kind of follows this pattern. So let's go ahead and get started. Today is Friday, April the 22nd, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. And you can see the pretty sharp decline that we had, finishing the day at a really, really important level for the S&P 500. Obviously, the momentum line, near-term line dropped into the reversal zone. The price itself fell 4% below the 30-day moving average. So we have dark pink shading, the intermediate line's dropping. We don't have the red line yet, but 4% below, pretty good chance we will get it. It's hard to get back. It will be hard to get back above it, so unless we get a really sharp bounce on Monday. But this level here, so this 42.75 area, a little bit more, a little bit less. That's the 23% retracement of this decline that we have been retracing with this intermediate run. We never did flip the script, right? We never did get above the 78. That flips things around, makes the bullish moves the impulse moves now, and not the bearish moves. We never did that. So while you're in the middle between the 78 and 23, you're still just retracing. But when you get back out of it, either to the downside or to the upside, you're not retracing anymore. Again, if you break out to the upside, you're not retracing anymore because you flipped the script, or you're now bullish. If you break back down below the 23% line, then we're back on the bearish move. And you can see that's kind of what we're getting. Now, it's just barely, so I wouldn't necessarily say that we've broken it. But you can see how close we are and what how important Monday will be. Considering if you look at how far below the 8-day moving average we are here, 8-day exponential moving average already. We're 3% below. We've been lower. We were 3.5% below over there. And you notice each of these times we rallied, but not in both. But not before. We didn't start the day lower, open the day lower the next day, and then really went low on an intraday basis for rallying hard intraday. Same thing over here. We started the day lower, way lower. After being down 3% below that time, we started the day lower. We went lower intraday and then really rallied hard. Went lower early, and then rallied intraday. So we're 3% now, but again, considering especially that was a Friday, I wouldn't be surprised if we opened the day lower, went down initially, and then rallied intraday. I don't think necessarily that the selling is done. I just think that it's hard to be this far away from these moving averages for too long. As you can see, we every time we move back to zero, we move back up to the 8-day moving average relatively quickly. The green line, this intermediate line, again, so here's your intermediate rally that we had, right? Dark green shading, green line. We pulled back. We pulled below the 23, started to retrace. Pulled below the 38, broke some support there, and now broken the 62%, and then again, when you break the 78, you're not retracing anymore. you flip the switch script here, and so we would be back to, it was a bullish intermediate run, we'd be back to bearish. So two lines right there that would tell us that we'd be back to bearish moves, and so it's really important. Now again, I wouldn't be surprised if we don't end up actually touching this 62% line before we touch the 100. But I do think we will touch that 100 and go through it. I think we will get to that 0 and go through it. There's a 23% retracement line. I believe ultimately, and I don't think it's going to be like this week, but I believe ultimately we're going to get to that 38% line at least, right, which is down to 3,800 at least. So again, I'm not saying that's going to happen this week or like the world's going to end or anything like that, but I think that's where we're headed. But I wouldn't be surprised if we don't touch the 62% early this week and then touch the 100%, maybe not by the end of the week, but eventually within the next week or two. Again, because it's so hard to stay this far down below moving averages. And if we do touch it tomorrow, then really, again, similar to this, right? You get that big move to the downside intraday. You get that big move to the downside intraday. So if we do touch it tomorrow, you might get a really good buying opportunity. Again, very short term, right? Very short term, because we're not going to, I don't believe we're starting a new intermediate run anytime soon, but it would be a very significantly, extremely oversold rally, and that would be nothing more than that. And again, it would be like, it probably have to be tomorrow, and we'd have to really start down lower and then really go down lower at the open tomorrow to set up that possibility. I think it's more likely we open up a little bit lower tomorrow and then rally gradually throughout the day. And like I said, get up towards that 4,300, and then that would be it, right? Then that would be as probably as far as we can go. And it doesn't take long for the 8-day to get down there. That's the S&P. The NASDAQ, you notice, it has broken that 23% line of the orange. It did it the day before on Thursday, and then now has also broken that 78, the one that the S&P is sitting on. So you can see the NASDAQ, and it has dark pink shading in a red line because the intermediate line now is below 40, and we are pretty far below the 8 days. So again, short-term rally is all I expect based on how far down we've fallen in the last 2 days. The Russell 2000 has broken below that 23%. It already had done it the week before, so it wasn't, it was already broken down. But remember, it didn't go up as much either. And then you've already broken that 78% line of that very short intermediate rally that it had. Its intermediate line, dark pink shading in a red line, its intermediate line's already in that bearish territory, already below its market sentiment line again. And then again, very bearish short-term sentiment. Let's take a look at the weekly versions of these market forecast charts, since it is a weekend, and you'll notice here that look at the bearish short-term sentiment on the weekly chart, and also look dark pink shading in a red line again up here, and you can see that the long-term view here, we haven't scratched the surface of any kind of correction. When you hear that people are talking about that, we're in bear market, nope. The numbers don't matter, right? The numbers don't matter in terms of how far down we go and whether that's a bear market because of this, right? We rallied so much here. If I were to go like to a bigger number for these pullbacks, 114% rally, a 20% drop is not going to be a bear market. It's not when you're coming off of a 114% rally. So, we haven't scratched the surface on any kind of correction. We are just starting to correct. And again, that's not me being doom and gloomer. It's just me the reality is, like it's the NBA playoffs, and I always use basketball analogies. But when you are down 10 points in a 100-point game, that's not nearly as big of a deal when you're down 10 points in a 50-point game or a 60-point game, like a high school game, versus an NBA game where the average is, you get 100 some odd possessions a game. So it's a much, much bigger deal in a smaller possession game, even if it's just like AAU running clock. Like 10 points is a much bigger deal than it is in an NBA, as we saw over the weekend. 20-point leads were very easily overcome. It's the same thing here. You have such a big move higher. A 10%, 20% drop is nothing. It's a much bigger deal coming off a 44% rally than it is coming off of a 114% rally. Let's go back. Again, so I showed you the intermediate line, had been in bearish territory already. But you look at the market sentiment, like it's barely, like when market sentiment, there's the correction that we had in 2018. There's a COVID. like in 2018, the market sentiment got into neutral territory. Now it won't get into bearish territory unless we're typically in a bear market, right? When you're in a bear market, that's when it gets down over here, as you can see. Market sentiment line gets into bearish territory. Coming off of that, you can see there's 2011. There's that correction we had, but market sentiment got down into the low end of the bullish territory. Like I said, in 15 and 16, it got into neutral territory. In 2018, eventually got into neutral territory. We are just barely dropping below 80, right? So if we're in a correction mode, we've got weeks, not weeks of straight going down every day. There'll be plenty of up days, but the market sentiment line is barely dropping, and we're not even below 23%, and we just barely have 1 week of dark pink shading in a red line, and that's it. The NASDAQ looks a little different. It's already in bearish territory, right? So it's already in bearish territory mode here. Oops, there we go. It's already in bearish territory mode, very bearish short-term sentiment, extremely bearish to get the near-term line down that low. And again, you had light green shading for quite a while, but now you're back to dark pink shading in a red line, and you can see you are below that 23% retracement, and you're headed towards that 38. And we'll see what we do at that level. 11% below the 30-week moving average. The Russell 2000 also has broken below the 23% already. Is also going to be flirting with the 38% soon. And then look at its intermediate line on the weekly chart is so bearish. And the market sentiment line is already almost out of bullish territory. So again, we are in correction mode. The Russell is. And the Russell has corrected a lot already that the S&P just hasn't yet, because and the same thing with like ARK investments, right? Everything along this end of the risk appetite scale has already corrected. So this correction in these bear markets that are on the furthest end of the risk appetite scale are gravitating more towards the safer end, right? The S&P 500 and Dow Jones Industrial Average. If you look at like Bitcoin, which is something else that's also on that far end of the risk appetite scale, you can see it's still dark pink shading in a red line. It's barely flirting with 40,000, but it's in the market sentiment line is below 50 and dropping, and intermediate line's well in bearish territory. So, and we have broken that 38% retracement. So it's in correction mode here, and the S&P most likely is headed towards that too. Let's take a look at the other weekly chart. All right, let me take a look at the S&P, and you can see you're back below the 40-week exponential move. The Heikin-Ashi close, which is a more significant close, right? It's the open, high, low, and close average. It is below the last week's low point, very bearish. You did get a high upper shadow, that's not as bearish, but the close makes it very bearish there. Your PPO is falling and hasn't even gone negative yet. And then which again, remember, we're just in the early stages. And then your Heikin-Ashi differential is negative, right? You have a bearish candle. That's the S&P, which is about a week behind the NASDAQ and the Russell. See, the NASDAQ has a negative PPO that's also falling. Very bearish candle. We had a bearish candle last week, though, closed below the prior week's low point with that transition that had the red arrow there. And then the Russell 2000, same thing, bearish candle. Did not close below last week's low, so not as bearish there on the Russell. But the Russell has been more bearish, right? We've been negative on this PPO for a while. It's back to falling, and you can see the negative differential there. Looking at the 3 green arrow charts, we were kind of thinking, okay, if we can just get 1 day of light pink shading, we'd be okay. And no, it's not the case. We got light pink shading for multiple days on the Qs, sporadic, but still no green shading here at all on S&P. And then a lot of pink shading here on IWM. And finally, your first day, again, the safest end of the risk appetite scale, the diamonds, is your first day of 3 red arrows and light pink shading. So that's instead of being a very bullish 3 red arrow signal, which is typically can be really bullish when you get 3 red arrows like that, you would not expect this one. This one is a bearish 3 red arrow signal. Let's look at those indicators broken out. Look at the S&P here. Broken below the point of control, the 8 and 17 day moving averages. See how far below we are. So that's why it's hard to stay that far below. When you get that far below, you tend to snap back to these short-term averages. You get that far below, you snap back up. So we are pretty far below, and I wouldn't be surprised if we come down here early Monday morning, but then probably snap back up. But then again, we will eventually, in my opinion, we will eventually get down here. I just think it'll be very short. Any rally we get would be very short term. And remember, when you're in bearish moves, you get plenty of green bars here. So any rally would not be, oh, well, we're done, right? And it seems like that way on TV, especially. Is this the low point? I mean, we're going to have a lot of segments on financial media, news media. Is this the low point? And so just forget about that until really we get towards on the S&P 500. Forget about like the low point until we touch that 200-week moving average. Again, the IWM is headed towards it and is closer to touching it. The Qs is further below the 50 than the S&P is. But when we break the 50, we typically go towards the 200. You can see there in 18, COVID, we went through it, but we snapped back pretty quickly. It's just the issue is, and why it seems so far-fetched, is because the gap is so big. And the gap is one of the biggest gaps we've seen since, especially, it is the biggest one since the 90s. But there's going to be lots of up days, and there's going to be lots of bullish near-term runs. And there may be another short intermediate run like we just had. But we won't have the low point until we get around that 200 day. Now, it might not be down there because the intermediate line, that near-term line's rising, right? When we finally broke the 50 over here, it was a few weeks. It was a few weeks there. So it's going to be weeks before we touch that. But just be prepared for lots of up days in the between those. It's not going to be every day a down day, but there's going to be lots. Every impulse move is going to be to the downside, and every pullback is going to be to the upside, even if it's near term or whether it's intermediate or anything like that. Let's take a look at some of these other oscillators, because they're giving us breakout signals here. You can see the directional movement index above 30, the negative index broke out above 30, the positive broke back down below 20. That's breakout levels. So you would expect the ADX to rise again and get up to whatever. You can see when you get above 30, below 20, that's breakout levels. You have that across the board on all the major ETFs, on the Qs, and then on IWM. So we have them all across the board. Same thing with the RSI and the CCI. You broke 40 and you broke minus 150 on the S&P. You also did it on the Russell 2000, and you also did it on the NASDAQ 100. Not quite below 150, but breaking below 40, and without getting up to really strong levels either. So I mean, this is a bearish peak when you're barely getting above 60 and only for a couple of days. That's a bearish peak on these indicators. Looking at the Bollinger Bands, especially at the Bollinger Bands, with the Keltner channels. So we're not below the lower band, and you typically aren't, right? That usually starts the bearishness, and you get in below the lower band. So we're not below the lower band, and we might get a little bit below it, but we are below the lower. The bands are outside the Keltner channels, and we are out below the lower Keltner channel. So that's a bearish trending pattern. It would be opposite. It would be a bullish trending pattern. So that's a bearish trending pattern. You can see the whole average too. Like we're not going to anywhere close to flipping that parabolic SAR to the downside. That's how far up it is, and it's going to start dropping. It will drop rapidly as we drop. It drops rapidly, and you can see you get your biggest moves when you're that far away from it. So we're going to get good upswings, right? And it might be tomorrow. It might be on an intraday basis after initial drop. It might be Tuesday, but we're going to get a really good bullish move sometime this week on some kind of level, intraday or a full day, whatever. But it's not going to be a trend changing, right? It's, the whole is red. The 200-day is red. We're breaking back below the 200-day whole moving average by a significant amount, 3.5%. That usually means we'll be trending down here for a while. And the 20-day is back below the 200. We are well below that 20-day, which is another reason why we might snap back pretty quick. And you have these. This is the these aren't the Hakinashi. There's your that's one Hakinashi candle. Like you expect that we'll get a multiple bearish Hakinashi candles here. So that's kind of what we're seeing there on the whole in terms of a trending indicator. Your trend strength indicators. You're starting a weak bearish trend below -1, above 50. We're back below the cloud, but just barely. We might come back up to the cloud tomorrow, the next day. I don't think we'll go back up through it, but I think we might snap back to some moving averages before coming back down. But not enough to change that this we're probably headed towards another one of these where we get to, below -5 and above 80 and really, start a significant trend to the downside. Our volatility, you would think our volatility must have really spiked. Well, it did. It got to 28, but it only got to the 95% mark. That's some resistance. So again, another reason why we might, have a little bit of a short-term drop or a rally, a drop in volatility back down to the 90% mark where there might be some support now, because these lines act as resistance and support levels when you hit them in one direction or the other. So we might hit that 90% first before we hit the 100%. But you notice we're not to the 105%, which marks an intermediate drop, which this is a way more than an intermediate drop. In fact, this is way more than just a typical market sentiment. This is a full-on correction mode. You can expect 125%, and we're nowhere near hitting 125%. And that's usually how much this will spike. As you can see, when you go out to the last corrections, obviously we hit 125% easily with COVID. That was crazy. But there's your typical, more of a typical correction. 2018, you can see we got to 125% there before when we finally peaked. In 15 and 16, the other previous major correction, we hit 125% at the beginning of the correction instead of the end, like 2018. And then in 2011, right here, you can see we hit 125% at the beginning. So obviously we did not hit 125% at the beginning. So like 2018, we were more than likely going to hit it at the end. And so Friday was not the end, at least in my opinion, was not the end there. And you can also see too, when you look at the volatility on this line, on this chart, we're back above the 50, the 8 and 17 day are back to crossing above the 30. And if you look at the weekly version of this, we're back above the 8 and 17 week, and they're all rising. All these long-term moving averages are rising. We are in this regime of bullish volatility right now, which makes sense. We're in a quantitative tightening, rate hikes. Is volatility typically rises when you have rate hikes, and that's what we're seeing here. And then finally, let's look at the volume. You can see the volume is just very significant. 132 million shares, a big range of 12 points. I mean, these are off the charts levels. 132 is up here at the top, so that's not quite off the charts, but way up here. The 12-point range is off the charts. You can see the ATRs, really taking off up here. We are really moving now. And if you look at it on a weekly basis, because that was only really one day, volumes are high, but you can see the ATR still can get higher. If you look at prior corrections, COVID is a little bit of an anomaly, but there's 2018, the ATR on a weekly basis got to almost 5%, about 4%. You're about the same level here in 15 and 16. In 2011, we got up to 5.5%. So we're at 4% with a 16-point range. I would expect that we'll get more weeks like that. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, and especially on my market outlook tweet that I have pinned at the top of my profile. Reply to that tweet with any charts or indicators or any tweets. Reply to with somebody else's tweet on what you're looking at, what charts or indicators are telling you why you're either where you agree with this, that kind of support that, or you disagree with it, and share why. What are you looking at that tell you why you're either maybe a lot more bearish than I am, that you think we're on full-on apocalypse mode, or you're a lot more bullish than I am, that you think this is the buy the dip of the century. Post that and reply to that Twitter, and let's share and get a little bit of a conversation going there. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked our video today, and two, you want us to do another video again Monday. Quick way to let us know you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. But it's a quick way. Like I said, you can do it right now even while you're watching. Also, comment down there. What stood out to you from today's video? Post your comments down in the comments section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on a blog, check out some of these things on the right. Click on this icon here. It takes you to our Market Outlook live page, right here. And you can see on Monday, Wednesday, and Fridays, I do a live quick 10-15-minute video here. I take a look at all the trades we've already placed in prior Market Outlook videos to see whether we should stay in them or get out of them, talk about why and how. We also put on today's trade already before the weekend, before the market closed. We did that there too. You can check out all the archives on this same page as well. Get to that if you can also get to it by clicking on Live Trade Review in the main menu. Come down here and you can click on see our upcoming classes. Click on View More. It takes you to our full calendar, our upcoming week. Full of classes here, as well as recordings that go back 4 years, last week and 4 years. So you can check out everything there. Come down here, click on that heart. It opens up this tab. Hit that like button. Same thing with this thumbs up icon. It takes you to this tab. Hit that like button. Again, the more you do that, it helps get our content out to more of our followers. That's why we always ask. It also helps you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. All right, now let's take a look at what's driving the price action this week. And you can see going into yesterday and going into Thursday, stocks were good. They were up for the week. IWM, the Qs, S&P were up 2.5% for the week. Real estate obviously doing the best. Bonds were actually up for the week, and developed market stocks were up. The emerging market stocks were down. Gold was down. Commodities are down. Those were all areas that had been doing pretty bullish on this run of like inflation, responding to inflation. But then you can see what happened over the last 2 days. In fact, look at what happened. Let's just zoom in on those 2 days by themselves. You can see nothing was up. Only the dollar. Everything started up. You can see Q started the day higher, but by the end of the day, nothing was up. And then today, or Friday here, in 2 days, the Qs were down 4.5%, IWM down almost 5%, S&P down 4%, just in 2 days. Again, doesn't mean we can't go lower, but more than likely, that's a that's a snapback. We might snap back up a little bit. Just a little bit. Like, I don't think we're obviously would snap back to any kind of bullish move. And again, we might actually get a gap, a significant gap to the downside, and maybe even some more selling early before we get maybe an intraday rally. That would be pretty sharp. If you notice here, the developed markets, emerging markets, they were down, but they pretty significantly outperformed U.S. equities. I think that's going to be a recurring theme throughout the rest of this correction. And you can also see, too, commodities were down. Bonds were down as yields took off. The only thing that was up, and gold was down, the only thing that was up, though they did outperform equities. So even though they were down on an absolute basis, they were up on a relative basis. So, there's some outperformance there. You can also see, too, that even though bonds were down, if you look at, those bonds, we'll look at the 10-year bond relative to investment grade corporate bonds, they were up. So you can see things are shifting. And when this goes up, it's bearish for risk appetite. And you can see the shift going on right now. We are moving here to the upside in that, there's the 200-week moving average. We're moving up against it right now. The 30-week has just crossed the 50. We've been moving up pretty much all year. And you can see when this goes up, it's typically associated with risk aversion, not risk appetite. And that's what we see, like the PPO. If I look at the PPO, the long-term PPO for this, the very, very long-term PPO, it's been so negative because the 50 is below the 200, and that's the case. When you're really bullish, that will be very negative. It's not going to be positive for very long. Only during bear markets is when it's really positive. But you can see it was pretty positive going into 2007 already by the time the stock market peaked, and then in 2008. And you can see there's been periods where, 2011, 15, 16, 2018, COVID, there's all your corrections, and here's another one, right? Neither one of these, though, really, the 15, 16 did get above the 200-week. The 2011 barely did, and COVID did, and it just snapped back down pretty quickly, and the 18 didn't. This one, we're just starting, so we'll see if this one ends up getting closer to where the PPO actually gets positive again, like it did at the end of 2007. So even though long-term bonds are falling, that you see investment grade bonds falling too. But look at that dollar. That dollar move is really significantly bullish. If you look at it, if we look at the comparison here of the dollar over the last couple of days compared to all the other major currencies, so this here, last couple of days, you can see the dollar was up against everybody. But here's the kicker. The dollar has been up mostly, but ahead of this, it was mostly up against the yen and the euro. All these other currencies were actually outpacing the dollar. But the dollar index was rallying because the euro and the yen were so bearish. But look, not so bearish. They outperformed everybody. I mean, that Aussie yen, if you look at the Aussie yen here, let's look at, again, a commodity related currency compared to the yen. It had been so bullish, basically had gone parabolic, but now it's reversing, right? We had been in bullish convergence mode, but now that we're breaking below that 17-day, this is risk off, right? This is risk on when it's moving up, and this is risk off, like that. And that's why you see, like, same thing with the euro. The euro had been so bearish. That's why you've seen the dollar be so bullish, because the euro and the yen were so bearish. But now you can see those relationships are flipping, right? They're flipping. The euro's taking off against these currencies. The yen's taking off against these currencies. So the dollar might end up being bullish, but don't expect like the dollar index may end up being bullish, but mainly because it won't go up like this again. It went up like this because the euro and the yen were so bearish. If the dollar goes up, it will really kind of maybe just grind towards that 100% line, this old high point, and then just kind of stay there. And like it's maybe even drop down because of the strength in the euro and the yen that you will expect to see. Again, go back to those same charts on the Aussie yen for an example, and let's go to the long-term chart of this, the weekly chart. I mean, look at that long upper shadow, and a couple long upper shadows here, but long upper shadow. But look how far up the MACD is. Histogram has already peaked a few weeks ago. The MACD appears to be peaking. We've gone more parabolic than we have been. This is the PPO MACD, so it's normalized. So it's not just higher because the price is higher. It's higher on a normalized basis. It's the highest that we've seen in the last 5 years. If you go back out 20 years, you can see some of these other periods where it had gone parabolic, and look at the sharp moves to the downside. And over here, it's gone parabolic because you're coming off a significant bear market low point there. So it appears that we are headed towards that kind of move again, which would be probably pretty bearish for the dollar. And in this case, right now, it would be associated with risk aversion, right? Because the yen would be considered a safety. If it's going to be bullish, it's going to be considered a safety asset class. Let's take a look at long-term bonds too while we're here. So long-term bonds have been so bearish, right? But you can see they're near support at that point of control. In this case, over the 20-year point of control. It's a very significant support. We are well below the 200-week moving average. So we are in bear market mode in bonds, which again kind of suggests where we're headed with stocks, because bonds lead stocks. So if you were to look at the analog for stocks, remember are right here right now. The S&P is just barely breaking the 50-week, right? If you look at the S&P, it's barely breaking the 50-week. So if bonds lead stocks, long-term bonds broke the 50-week in the end of 2020, and then had a correction, and then had the correction bounce that failed, and then now is in bear market. Now I don't know if that took a full-on year plus for that to happen. But this is where we're at. So this, you can see, and that was a pretty wide gap too between the 50 and 200-week moving averages, and bonds filled it relatively quickly. So again, it's not far-fetched. And you can see bonds are extremely oversold. This is the lowest. This is the most bearish momentum that this ETF has had in 20 years. In fact, I think if you can go all the way out to maximum, it is the lowest. This is the lowest the MACD has been ever for this ETF. This is the most bearish. And there's been some pretty bearish moves here, as you can see. And you can see when you've had these pretty bearish moves, it pretty much sets a low point for bonds going forward. And I think we are. And I don't think this is like now tomorrow will like spike up, but I think we are going to build a below point in this area here, as the bond market is pretty much priced in. And you can see with the yield spread the bond market has, we were around 20 basis points, but that's pretty flat compared to where the yield spread has been, right? The yield spread is at 150 basis points in 2021 and is already down here. So if you go back out, to 2013, remember the Fed didn't start raising rates until December of 2015. So the bond market was already starting to price it in, and the bond market didn't get down to these levels until the end of 2018 by the time the Fed raised rates the last time. 3 years worth of rate hikes, and the bond market finally got to the end, right? They pinpointed the end of those rate hikes by getting the yield spread flat after 3 years of those hikes. The bond market has already priced in all these rate hikes, and it's lots of rate hikes, right? We're looking at, by the end of the year, you're looking at a relatively high probability of up to 300 basis points, which is the Fed's talking about that, so that's why it's priced in. So the bond market is priced that in, right? You can see the 2-year note is up to it's down so far down to 2.64%, but you can see that how far up it's gone. Like it's up there. It's up towards that 300 basis points already. It's priced in. The bond market has priced in what the Fed's likely to do. The stock market, on the other hand, has not quite priced that in, right? This is a very strong bullish level, and we're nowhere near that 200-week moving average. And remember, the bonds are way below it. And then you look at gold, which is another safety asset class, and it's trying to figure out, remember, it's back above this 23% retracement. It had this bullish move going during this bear market that we had from the end of 2018 to the COVID level, to COVID and then through it. Right, there was that fake bear market that these tech stocks, mega cap tech stocks, kind of masked that bear market. But you can see it here, and you saw it in bonds too. And then we started to retrace that. We retraced it down to the 23, but we got back above the 23% line, and we're still above the 8-week. A little bit of a pullback here, but you expect that this will stay bullish and continue to trend, especially being above the value area, trend to the upside there. Let's take one quick look at sectors before we move to our trade idea. And you can see our 12 grid for all the different sectors. I mean, there's dark pink shading across the board here and red lines, yellow on the discretionary. And you can see your materials is finally breaking down. Energy is finally breaking down. It has not broken down any of this rest of this time, but it's breaking down now. Real estate's not looking good. Utilities, everything looks. There's different degrees, but everything's breaking down. When you're bearish, everything moves. See, energy hasn't been moving. Energy has been relatively bullish while everything's been bearish. That's not the case this go around. Everything, when you're in a correction, everything goes down to different levels, but everything goes down there. And you saw that with that chart I showed you. Here, let's look at, I don't think I showed the comparison. Let's just look at the last 2 days again. April. We've got the 10 minutes here. Yeah, and you can see, again, everything is down. Staples down as much. Real estate not down as much. Utilities not down as much. Some of these others, materials and energy, way down. But everything is down, and that's very typical. And you would expect that will continue to be the case. And really, year to date, everything has been down except for energy. So, there might be some, the energy's lagging, so it goes down last out of all of these. And these are leading. They will go down earliest, because they're the biggest market cap weightings. So they'll go down the most, earliest, then they'll stop, and then commodities, materials will come last, because bonds go first, stocks, and then commodities last. And you'll see a lot of these stocks. They have been so bearish that it can maintain some bullishness while everything else lags behind. But look at your safety trades. They're up, and you expect that they will continue to outperform their more cyclical counterparts. All right, so for our trade idea of the day, I wanted to take a look at Square. It's kind of one of those stocks that's been associated with ARK investments, and those kind of, you can see how bearish it's been. Look at all those oversold clusters. Look how low the market sentiment line got, and it's had a good run. This little intermediate rally, it retraced up to those levels there, wherever those ended up being. Let's see here. So we probably ended up peaking right around this area here, and then down to that low point. So you got up into that 38% retracement area, We're obviously back down below the 23% line, and you have like dark, again, dark pink shading and a red line. Intermediate line crossing back below its market sentiment with some very bearish short-term sentiment, 18% below the 30-day moving average. Obviously pretty darn low already, but you can see the bearishness here. Let me show you the same the Keltner channels here with the Bollinger Bands on square. The bands are outside, so we have green just the last couple days, and we're back below that lower Keltner channel. So we're trading in the area. You can see between the Keltners and the bands where you're trending, and that's pretty bearish in the lowest quartile for the stock. You can see the RSI and the CCI back down to bearish levels. I mean, it looks very similar to the broader market as a whole. The DMI shows a bearish breakout above 30, below 20 on the DMI, and you can see just barely starting. We had enough of a correction to bring that ADX all the way down to really low levels. So there's an opportunity for a trending move to begin again. Here's the Ichimoku cloud back below the cloud. We were close to having an intermediate strength trend, -2 and above 65 there. So really good opportunity for a bearish move on the stock. So what we did is we went to buy. We did a pretty aggressive trade. If you notice, there is earnings coming up here after May expiration. So we went to out of the money 85, buying the 85 put, then selling the 80 put to offset the cost. So it's pretty aggressive. Here's one standard deviation move for Square down to $75 is where it can get you by May expiration, and so 80 is what we're shooting for it to get down and stay down to get a 3-to-1 reward to risk ratio. And you can see the risk is really small, and that's at the worst case scenario too. That's if you decide not to get out early. Of course, if things change on the stock and we were to get back above some of these moving averages and point of control, we can get out early. But I mean, you can see breaking below the point of control, breaking below the 8 and 17, crossing back below the 30, and pretty close to crossing back below the 50, that there's an opportunity for a trending move to develop and for us to be bearish on this for a little bit of time. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon down below. A comment on the video. Remember, you can also subscribe to our website at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all next week.